Hey, everybody, there's a bit of a buzz out there on Dave Ramsey and what he's saying about withdrawal rates. And so I wanted to talk about this because it is a topic of conversation. One thing that I'm seeing very clearly right now and very commonly right now is a false sense of security. Look at the last 10 years in the S&P 500, including the pandemic. The pandemic, you see it on there, but it just disappeared so fast, right? We haven't really had a big downturn in the stock market that hasn't rebounded in this, few days afterwards for over 10 years now. Market has gone up and up and up and up in the grand scheme of things. So Dave Ramsey on his show and even on his website is claiming the S&P 500 averages 12% a year. Well, so now he's yelling at everybody that says 4 to 5% withdrawal rate is a safe withdrawal rate from your portfolio. Okay. So there's an enormous amount of flaws in this, but I want to talk about how he says this and why he says this. So he said the common advice to withdraw only 4 to 5% of one's retirement savings annually is moronic, and that's a quote, advocating instead for an 8% withdrawal rate. He argues that this rate, adjusted annually for inflation, can be sustained without eroding principal balance. His strategy hinges on an unrealistic expectation of a 12% annual return on investment and a steady 4% inflation rate. So this is a flaw in math. Every time I see somebody try to do it themselves and illustrate their retirement, they use just a flat rate of return. Now, most people don't use 12 like Dave Ramsey does, but the reality is if you just plug in 12% rate of return every year, this works just fine. Nothing wrong with this. Sure, go for it, pull 8%. Because if you earn 12%, you can pull 8%. No big deal, okay? But Dave Ramsey believes in good growth stock mutual funds. No bonds, no annuities, nothing else. Just put your money all in the S&P 500. All right, so let's do that. For the last 10 years, or in this case, I use the decades here. So 2010 and through 2020. Okay, we got a nice little decade here. The last decade that we saw here, we put $1 million in. We do an 8% withdrawal rate, so $80,000, and we grow that withdrawal rate by his 4% every single year. And as you can see here, look at this. I mean, this last decade was fantastic in the stock market. We started with $1 million. We started by pulling 8%, and it got bigger and bigger and bigger out of it. And we did just fine. Dave Ramsey's right. We could do this forever. As a matter of fact, why not start pulling more? Stock market's been wonderful, right? Stock market was wonderful in the 80s. It was wonderful in the 90s. It was wonderful in the 2010s. The jury's out on the 2020s, but it's starting out pretty good right now. So the reality is when we have good decades, these numbers work out great. Dave Ramsey is right. And people that are retiring right now have that false sense of security because it's been so long since we had a legitimate downturn in the market. And that's a little scary. This false sense of security can give you confidence that maybe you shouldn't have. We have to be careful about this because if you're wrong, it ruins your retirement. And if you're 70s, 80s, it's not like you can just go right out and get another job and start working again, right? So here's the problem with all of this. That same $1 million deposit, that same 8% withdrawal rate, inflation at 4%, the same withdrawals right there. But hey, let's use a different decade. Let's use 2000 to 2010. And I want you to notice very quickly, this decade looks a lot different than 2010 to 2020. And the results are the polar opposite. You ran out of money. And for those of you that understand the order of returns matters, this is scary, Okay, we can't have that false sense of security. If you retire and things start faltering in the stock market and you're relying on this withdrawal rate with no backup plan, you got a problem. This plan falls apart in the 60s, it falls apart in the 70s, it falls apart in the 2000s, and again, the jury's out on 2020s. So we have as many decades that this plan doesn't work as this plan does work. So is Dave Ramsey right? No, he's wrong. You can't rely on that. You can Monte Carlo this all you want, but you're looking at flawed data. We've had interest rates coming down for 40 years. They finally hit bottom and started ticking back up. Some of your investment choices are going to react differently. Plus, the past doesn't always equal the future, and you have no idea what the returns are going to be like after you retire. We have to be careful. So what do we learn from this? Well, I want to hit a little quick list here of what we have to take away from this. You can't control the order of returns after retirement. If I look at the last 100 years in the stock market, maybe I'll come up with 12%. I think it's actually closer to 10%, but fine, let's go with 12%. But the problem is that's without touching your money. That calculation is without withdrawing your money. And the order of returns matters when you start withdrawing the money. Just because a mutual fund averages 12% doesn't mean it's better than a mutual fund that averages 5%. And that sounds crazy, but it's mathematically accurate. If you're just investing money to grow it, 12% is always better than 5%. But if you go to withdrawal, what you have to look at is the volatility in that portfolio. And 12 is not always better than 5 when it comes to the time when you start withdrawing. And that's scary. And I've got plenty of other videos showing the math on why that happens and how that works. So upon retirement, you have to change your priorities. Don't lose your money. And this means a lot of different things, okay? So first of all, speculative investing, there's no reason for it. Buying individual biotech stocks that you think you want to carve out a tiny little portion of your portfolio, just like you would go to a casino, go for it. I don't really care about that, but meaningful amounts of your money should not be going into private investments, speculative investments, unless you are okay losing that money, period. The other thing I want to make sure I'm very clear on, when I say don't lose your money, that doesn't mean don't invest in the stock market. If I own the S&P 500 and it's going through fluctuations, even if the market's down, I'm not losing money. I'm only losing it if I need it and pull it out. So I want to be clear, fluctuations in the market is not losing your money. It's only losing your money if it's down and you choose to pull it out. That's a loss. So losing your money through speculative investing, buying an investment that goes to zero, and losing your money because you don't have the proper plan and you're pulling money out when the market's down. Those are the ways you lose money. That's the big no-no in retirement. Don't do it. The next one, don't lose your money, but try to keep up with inflation. There are plenty of ways to calculate if you have enough resources in retirement. If your current resources meet your needs in retirement, then all your job is don't lose it and try to keep up with inflation. And then you will have an enjoyable retirement from a money standpoint. It's that simple. Do the best you can to keep up with inflation. Your growth parameters change. You're not reaching for the stars, trying to knock it off the planet. An extra 100,000, an extra 20,000, an extra 50,000 shouldn't change your retirement. I want to be clear on that. So important we understand those parameters. The next one, the larger your withdrawal rate, the greater the effect of volatility. The larger your withdrawal rate, the greater the effect of volatility. And that is Dave Ramsey's big problem. He doesn't understand math. He doesn't understand the order of returns. He doesn't understand that the withdrawing phase of his life is going to be different than the putting in phase of his life. The returns you see in the stock market are based on not pulling money out. We have to be careful about this. The larger the percentage, the greater the effect of that volatility. The higher your dependence on your portfolio for income to pay bills, the less it should be left to chance. You will never enjoy your retirement. That's a huge part of the psychology of finance. Okay. If you're relying on that portfolio to produce income for you so you can keep the lights on, then you're looking at that portfolio every day, worrying about every penny in that portfolio. You have to be careful about that. And the last one is the mantra of depositing into volatility is great for building wealth, dollar cost averaging, all these wonderful things. I love Dave Ramsey for his budgeting. Okay, he lives in a world working with people that are mostly in their working years trying to build wealth. His budgeting and his every penny has a name, all his envelopes, all that wonderful stuff. Everybody should have that basis learning. I love it. But when it comes to retirement and investing in retirement and planning out your portfolio and how you're going to enjoy your retirement, withdrawing from volatility will destroy your portfolio. So you need to withdraw from stability to maintain your wealth. That's what we learn from this. That's what we take away from this. If I can help in any way, you can always schedule 30-minute meet and greet or any other kind of appointment with me at yourinvestmentcounselor.com. We do full form classes on all of these topics. Every month we do a different class. Go to fpfeaz.org. That's a nonprofit we run here in Arizona. We broadcast the classes live via Zoom 3 or 4 times a month. And then give us a call if we can help out in any way. If you haven't viewed our full YouTube page, it has got everything. YouTube channel full of classes and little mini educational videos. Lots of wonderful stuff on there. Go to the full page, like it, subscribe to the channel. I put new videos out every single week. All right, everybody. See you next week. Thanks again.